Have you ever been traveling abroad? You go to an exchange counter and all of a sudden one of your dollars becomes like 25,000 of something else. It feels kind of like a magic trick, right? But it's actually pure economics. So why isn't all money just equal? Today, we're going to unravel that very puzzle, why currencies have such wildly different values. All right, so here's how we're going to break it down. First, we'll set up what I'm calling the value puzzle. Then, we'll dive into a nation's internal health, what's happening inside its borders. After that, we'll look at its role on the global stage. And to wrap it all up, we'll tackle some big currency questions that tie everything together. Okay, let's jump right into part one, the value puzzle itself. So, what is at the heart of this mystery? Why do we even have this thing called an exchange rate? I mean, why isn't one US dollar just equal to one Vietnamese dong? Well, the answer starts with something I bet a lot of you have experienced. So let's imagine a guy, we'll call him Bob. He's from the US, and at home, a dollar is, well, it's a dollar, simple. But the second he gets on a plane and lands in another country, that simple, straightforward reality gets totally flipped on its head. Check this out. Bob lands in Germany, and his dollar can't even get him one full euro. It's worth about 90 cents. Bummer. But then he hops on a flight to Vietnam, and that same dollar, the very same one, suddenly explodes into 25,000 Vietnamese dong. You see what I mean? It feels like some kind of weird financial magic trick. So, what is really going on here? To get our heads around this, we actually have to take a quick step back in time. See, for a long, long time, most of the world was on what was called the gold standard. It was pretty simple. A dollar was worth a specific fixed amount of gold. A country literally couldn't just fire up the printing presses and make more money unless it had more gold in its vaults to back it up. It kept things pretty stable. But by the 1970s, things were changing. Economies were growing fast and they needed more flexibility. And that pushed us into a totally new era. And that brings us to today. We live in the age of fiat money. And this is where things get really fascinating. Fiat money, the dollar, the euro, all of it, has value for one reason and one reason only, because we all believe it does. It's not backed by a physical pile of gold anymore. It's backed by our collective trust, our shared faith in the government and the economic system that created it. Okay, so if it's all based on belief, how is the actual value set? Well, this brings us to the master key, the one simple rule that unlocks this entire puzzle. The value of every single modern currency is determined by supply and demand. That's it. It really boils down to two questions: how much of that currency is out there in the world, and how many people want to get their hands on it. So if it's all about supply and demand, what creates that supply and demand in the first place? Let's start by looking inside a country's own borders, at the economic engine that really powers its currency's value. All right, factor number one is a biggie: inflation. You've heard the word, but what does it really mean for your money? Well, simply put, it's when your money just doesn't go as far as it used to. Prices go up and your purchasing power goes down. And if a country's currency is constantly losing its value like this, nobody wants to hold on to it. Not its own citizens, and definitely not people in other countries. You'd want to treat it for something else, fast. And if you want to see a really extreme example of this, just look at Zimbabwe. It's a wild story. Back in the 1980s, one Zimbabwean dollar was actually worth more than a US dollar. But then came years of economic chaos and the government just printing massive amounts of money. What happened? Its value wasn't just weakened, it was completely annihilated. That's a perfect, if tragic, example of what happens when that collective belief we talked about is shattered. No one wants to hold on to money that's becoming worthless by the minute. Okay, moving on to factor number two. This is another one you probably hear about on the news all the time: interest rates. These are the rates set by a country's central bank, and you can think of them as a powerful magnet for money from all over the world. So here's the chain reaction, and it's super important. Let's say a country raises its interest rates. All of a sudden, investments in that country, like government bonds, offer a much better payout. This gets the attention of foreign investors, who are always looking for the best return on their cash. But here's the key. To buy those bonds, they first have to buy that country's currency. All those people buying the currency creates a huge surge in demand. And what happens when demand goes up? The value goes up too. It's a really powerful way for a country to attract money from abroad. All right, so we've looked at the internal stuff: inflation and interest rates. Now, let's zoom out and look at how a country's role on the world stage, how everyone else sees it, affects its currency. When it comes to attracting foreign investment, you have to think about what big investors want. And more than anything else, they want one thing: safety. They're not looking for drama. They want to park their money somewhere they know will be stable. A stable government, a predictable economy, laws that don't change overnight. A country that can offer all that becomes a safe haven. And being seen as a safe bet creates a steady, reliable demand for your currency.
And if you want a perfect, real-world example of what creates global demand, look no further than the petrodollar. This is a huge deal. For decades, the world's biggest oil producers have priced their oil and only accepted payment in US dollars. Now think about that. Almost every single country on Earth needs to buy oil. And to buy that oil, what do they need first? US dollars. This system creates this incredible, constant, built-in demand for the dollar from all corners of the globe, which is a huge reason for its strength.
Okay, so now we have the main puzzle pieces, right? We've got inflation, interest rates, stability, global demand. So for our last section, let's put it all together and tackle some really interesting what-if questions about how all this plays out in the real world. So, what if you're a smaller country and you just don't want to deal with all this up and down chaos? Well, you can do something called pegging your currency. A great example is Brunei. They've legally fixed their currency to be worth exactly the same as the Singapore dollar, 1-to-1. What does this do? It gives them incredible stability because they're essentially hitching their wagon to Singapore's much larger, very stable, and well-respected economy. It's like borrowing financial credibility. And that brings up a really logical question, doesn't it? If stability is so good and dealing with all these different exchange rates is such a pain, why don't we just, I don't know, have one single world dollar and be done with it? Well, the euro gives us a pretty clear answer to that. Sure, having one currency is super convenient when you're backpacking through Europe, but there's a massive downside. When you share a currency, you give up a huge amount of control over your own economy. And when one country in the group gets into trouble, like the financial crisis in Greece back in the day, the problem doesn't just stay in Greece. The pain spreads to everyone else using the euro because you're all tied together. Now imagine that on a global scale. One country's major crisis could trigger a worldwide economic meltdown. All right, one last big question for you, and this one challenges a really common belief. We're always taught to think that a strong currency is a good thing, that it's a sign of a powerful, healthy economy. But is it always a good thing? Is it always what a country actually wants? Well, on the one hand, if you're a country that imports a lot of stuff, think energy, food, electronics, then yes, a strong currency is absolutely fantastic. Why? Because it means your money has more buying power on the global market. All those things you need to import become cheaper for your citizens to buy. So for importers, strong is great. But let's flip that coin over. What if your economy is all about making things and selling them to the rest of the world? For a big exporter, a weaker currency can actually be a secret weapon. It makes all your goods, your cars, your clothes, your gadgets, cheaper and way more attractive to foreign buyers. And this, by the way, is why you sometimes hear countries accusing each other of deliberately keeping their currency weak. It can be a huge and very controversial advantage in global trade. So when you pull it all together, you can see it's not just one thing. It's this complex, constantly shifting dance between all these factors. You've got inflation and interest rates at home. You've got foreign investment and global stability. You've got trade. All of it comes together to decide what a currency is worth from one day to the next. And that really leaves us with one last and maybe most important thought. We've talked about how our entire modern financial world isn't built on a physical thing like gold, but on a shared idea, a collective belief. So the final big question has to be, what happens when that belief gets broken? In a world with new digital currencies and big shifts in global power, that's not just an academic question. It's becoming more and more relevant every single day.